Though in the Federal Reserve this morning as we wait on the decision on interest rates that we will get at about 2 p.m. Eastern. Former George W. Bush economic advisor Marty Feldstein yesterday weighed in on what he thinks will happen.
I think they're going to pass. I think that they're not going to do what they should do, which is to start raising rates, start normalizing. But I think they have talked themselves into being nervous, and so I think they're going to hold back.
Craig Dismuke is joining us, Vining Sparks chief economist, and Danielle DiMartino Booth, a former Dallas Federal Reserve advisor. Good to see you both. Thank you so much for joining us. This is now a common theme. People are saying that we think they should raise, but we don't think they will raise. Is that where you are?
It is, and it's I feel a little bit like trying to bet on the Cubs winning the World Series or something. I mean, if you had shorted them for the last, but I mean, if you had shorted them for the last 5 years, you'd be right. I mean, they've gone through this iteration of 2013 will raise rates, then 14, then 15, then late 15, then 6.5, then well past 6.5, then for an extended period, and it just keeps going and going and going. If you look at the data and we strictly make a data-dependent decision, then I think you raise rates based on their analysis of the labor market and what the impact should be to inflation. And yet nobody has any confidence they're going to.
Well, I don't know about that, though. You got to push back on that, because when you look at the fact that 38% of working age Americans right now either do not have a job or do not even want a job. When you look at the participation rate, you look at wages that have not moved, and you look at retail sales that are sort of very slow. And then there's the whole international story where so many of our trading partners are challenged. Is it really a slam dunk, Danielle, that they should raise?
I don't think it is. And I'll agree with Feldstein's comments from a few minutes ago that policymakers are somewhat paralyzed. But what you bring up with in terms of the number of people who are out of the labor force, I think that's evidence that Federal Reserve, their ability to affect change for the workforce is absolutely exhausted. It's not their job anymore. But they're not going to bring these people back into the workforce.
Is it ever their job to do? I mean, I know it's in the mandate, but is it really their job? They didn't do one thing to help create more jobs here. They've created a lot of lousy jobs. And, of course, we've got Hewlett-Packard. They're laying off another 30,000 people on top of the 55,000 they already laid off. Schlumberger's laid off to over 100,000 people this year. But we're getting a lot of $12 jobs or $9 jobs, except if we move to Seattle or maybe New York, we'll get a $15
So then you're disagreeing with yourself.
No,
because you think the Fed
has to raise because
but they won't raise.
They will not raise. I said they wouldn't raise until next year, and maybe not even next year. That's what I think. I think QE4 is coming because I think the Fed is afraid. I think they're kicking the can down the road as they've done the entire time.
But you just gave us all these stats about why the economy is fragile. And
the economy stinks.
Right.
But if you raise rates, you can bring back independent, entrepreneurial people that are going to go to work and build a business from the ground up.
I see where you're going.
I don't think you get a lot of capital investment until the Fed gets out of the way.
Yeah.
I think that companies would rather buy each other.
That's what they're doing,
and or buy back their shares rather than actually invest in the future. And I don't think that they're not going to do much until they feel like there's a clear runway in front of them.
And right now we got this Wall Street Journal op-ed from Jamie Dimon. Okay, here's how to get growth back in the economy. Number one is investment in America's roads, bridges, tunnels, ports, and airports, physical infrastructure. Okay, that's his number one piece. Next is immigration, followed by public education, then trade policy, and then fiscal problems, addressing fiscal problems in the Journal today.
There's nothing to disagree with there.
No, I mean, except for infrastructure being the number one item. But, I wouldn't put the onus on the Fed for creating bad jobs. I think this is fiscal policy. It's coming out of Washington. It's the regulatory environment.
Yeah, I totally agree.
And it's the fact that we have an aging population. And one thing we learned from the Bank of Japan that the Fed has now learned is that monetary policy can't affect an aging population. Right. So when I say if you look at the data, what I'm talking about is the Fed has said that they're not going to wait until they see the white of the eyes of inflation before they raise rates. Instead, they're going to wait until the labor market is conducive to inflation. And they've said the number one metric that they're going to use is the unemployment rate. It's down to 5.1%.
Right.
We have more job openings in this country than we've ever had. We have 1.4 unemployed persons for every job that's open right now, the lowest number it's ever been. So when you look at the whole data, yes, we have people leaving the labor force because we have an aging population. But we also, when you look at the rest of the data, we have a pretty tight labor market, and especially using the metrics that the Fed has said they're going to use. So do we lose credibility in the Fed and what they've said?
I think we have. I think that's a past tense. I think the public has largely lost credibility.
What about 6.5% when they're going to raise there? What happened to that? Then now it's 5.1, and they're still not going to raise.
They keep moving the goalposts.
I mean, you have the imaginary movement of the Fed. It's always their data dependent, but their marks are not good.
I got to get your take on this, Danielle, because you are an advisor to Richard Fisher. You were an advisor
for the better part of a decade
to the Dallas Fed. Richard Fisher told me a couple of years ago that much of the job creation since 2007 was coming from the energy sector, in and around the energy sector, manufacturing, et cetera. Now, we know what's going on with oil prices, and we know that in the next couple of months, a lot of these shale players will have to redo their credit facilities. Does that mean we're going to see bankruptcies in the energy sector? And does that basically blow up this whole idea that we are, in fact, going to see an improving jobs market?
Yeah, I think it's a huge challenge for policymakers, because if you look at some of the biggest engines of growth over the past few years, they've been in manufacturing in the auto sector, and as you say, in shale. And those are very high-paying jobs. So if you look under the hood and you see the jobs that are being lost versus the jobs that are being created, you're losing people who are making in excess of $75,000 a year, and you're replacing them with people who are making $25,000, $30,000
exactly.
a year. That math does not work, and that's what's keeping a lid on wage gains.
But the point is so then you do think that the energy story is critical to growth in this country?
Think of where I live. I mean, in Texas, again, if you look at the month of August, we lost energy jobs and we picked up leisure and hospitality. That math does not work.
That doesn't work at all. And I do agree with Jamie Dimon, though, by the way, on the roads and bridges. I actually did a YouTube on that 5 years ago, that we have a big group of people, the older, 45 to 65, that are unemployable because they're industrial or manufacturers. They don't have an education to get a job. So
they wouldn't need retraining to build bridges and tunnels.
But you said that shouldn't be number one, you just said.
No, I mean, I think certainly there's other priorities I'd put in front of that.
All right, we will leave it there. Craig, good to have you on the show today.
Thanks.
Craig Dismuke, Danielle, good to see you. Thank you so much. Danielle DiMartino Booth.